HTJ.tax, the international tax firm for 6, 7, and 8-figure investors and entrepreneurs who are living that international life. Are you ready?
We're going to talk about retirement planning now. So Liz is asking how the 403B, which is a public sector retirement fund, IRAs, individual retirement accounts in the U.S., and Roth IRAs, which would be after-tax money, like we discussed earlier. How withdrawals from that in the U.S. tax in Australia, as she's Australian tax resident?
Sure. So if it's a public sector fund, it would depend on I'll start at the beginning. There's two things. If you can't, when you move to Australia, actually transfer your balance to an Australian fund, we're not talking about that. We're talking about what happens when you actually you met whatever conditions of release over in the US, and you're actually pulling out funds. In those circumstances, the double tax agreements, regardless of the domestic rules in either country, the double tax agreements ordinarily give, and from memory, the US, Australia DTA, gives taxing rights to the Australian, so the residence country of the individual, not the source country of the pension. So if that's the case, that payment, if it's assessable in Australia, even though it's not accessible in the US, then you've kind of blown up the tax benefit from a US perspective by being an Australian resident. And the reverse is also true. You could be in receipt of a tax-free pension in Australia, but live in a country that taxes that. The DTA assigns sole taxing rights to the other country, and you get taxed.
Right. And I want to continue from where you left off, because one would find, because, Australia is an international jurisdiction for people who work with multinationals. So it's not uncommon for Americans to do a stint in Australia and then return to the US. So they work with an Australian subsidiary of, one of the big tech companies or one of the big financial institutions, and they return to the US. And when they return to the US, invariably, because they spend time in Australia, they have a super. Now, it's not really portable. It's not easily portable. So they need to leave it in Australia until they retire. And now upon retirement, it's like, okay, I want to access that money. How am I going to do so? So as you pointed out, it may be tax-free to Australia, but it's taxable in the US. Now, I'll just comment, Liz, I know you didn't ask about this, but I'm just commenting generally. So we see like 3 approaches from a US tax perspective. They are the adventurous tax professionals. They say, well, the Australian super is actually like a social security program. Not in the actual legislation, but in legislative intent. Because in Parliament, when it was being created and when it's being modified, I believe it was mentioned that the intent is for it to replace its predecessor, which is, and in fact, a proper social security program as we know it. So these glamorous US tax professionals say it's Social Security, so it's not taxable in the US. We think that is an extreme position. You take that position on your own risk, and the IRS may come after you, and with interest and penalties and whatever. So that is a more dangerous position to take. On the other hand, you can just look at it as a straightforward distribution, and some sort of forensic analysis would be needed to determine, okay, what is the basis in the superannuation? How much was originally what was the original contribution, right? Mm. And then what is the delta between the contribution and its present value? And that delta, it will be subject to tax upon distribution. So as and when you pull it out, it'll be taxed at ordinary tax rates. So that's the other extreme. It's very conservative, and to be honest, that's the one we would feel comfortable with. There's a middle ground. Some people look at, especially with self-managed funds, SMSFs. Some people say, well, more than 50% of the value in the super is my contribution as opposed to an employer. So it's me. So therefore, I want to treat it as a grantor trust, and it can be treated as a grantor trust under US tax rules. In that case, you don't wait until there's a distribution. As there is growth in the fund on an annual basis, it can be declared and subject to taxes in the US. But that has some complications as well, because there is debates. There was an article that was published in one of the peer-reviewed legal journals in the US that was exploring that option of looking at it as a foreign grant or trust. And they're saying, okay, well, your contributions, okay, that's fine. We can look at it as a grant or trust. The fund will declare a 3520A, and you report that to the IRS, and you pay taxes on it on your personal tax return. But what about if you were employed at some point in time? What about your employer contributions? Would that be part of a grant or trust, or would that actually be a non-grant or trust? And so that becomes a bit complex. And then what about if the fund was used to invest in pooled investment schemes, some funds in Australia, right? So, or some equity funds. So it's possible that it would trigger something called PFIX, or passive foreign investment company tax treatment, which again is not to the taxpayer's advantage. So we think that this is on the other side in terms of someone being US tax resident with an Australian super and receiving a distribution. They probably need to sit with a tax professional to really go through the pros and cons of each of the possible approaches to see what would work most efficiently given your unique circumstances. So she's in Australia with US pensions. Any monies that are withdrawn from the 403B or from the IRA funds are taxed in Australia if you're a resident for tax purposes in Australia. James?
I'd be surprised if they weren't.
Right. And she's asking roughly what rate of tax would be applied.
It depends on we don't have separate tax rates for different types of income generally. It's just all pooled. So if you have any other type of income, it just all goes into the one pool, and it's assessed at your marginal tax rate based on what bracket you fall in that year, up to a maximum currently 45 plus the Medicare levy 2%.
Right. And the opposite obtains in the US as well. You just be taxed on your marginal tax rate as well, because all ordinary income is just kind of pooled
lumped in together.
Yeah.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.